This is Jody Trana with Chapter 4, Part 2 of Business Finance. In the previous PowerPoint, we reviewed the first three categories of financial ratios. That was liquidity, capital structure ratios, and asset management efficiency ratios. In this PowerPoint, we will be reviewing the fourth group, which is profitability ratios. Common size financial statements are one way that we prepare numbers so that we can compare them easily with previous years, competitors, and other companies in industry. Here's a common size income statement. A common size income statement is an income statement in which each line item is expressed as a percentage of sales. You can see here that sales is 100%, and each number is calculated as a percentage of sales. So cost of goods sold is 75% of sales. The really useful numbers are our totals, like gross profits, being 25% of sales, and our bottom line net income, 7.6% of sales. The first profitability ratio is gross profit margin. Let's think about what this is because not all companies track this information. Gross profit is the difference between your sales and your cost of goods sold, or your cost of sales. If your company is a service company, you may not have any gross profit margin number. Most companies will have a gross profit margin that can be tracked because there are generally some type of costs associated with providing your products or your services. This gross profit margin is a really important number because it is the first profit number on the income statement, and it shows you the amount of profits that you have to cover all the rest of the expenses of the business. We can only say that a higher gross profit margin is better than a low gross profit margin because companies are so different. A company would want to compare their gross profit margin to other companies, competitors, and people within the same industries to figure out if there's improvement within their gross profit margin. To calculate the gross profit margin, you would take your gross profit and divide it by revenue. Remember that gross profit is your sales minus your cost of goods sold. All companies will track an operating profit margin number. Operating profit is your sales minus your cost of goods sold minus all of your operating expenses. It's a really useful number, again, because it disregards very unique non-operating expenses that one company may have that is not typical, but other companies do not have. So it disregards these amounts. Again, higher is better, but we need to compare our company to other competitors and others within the same industry. You calculate operating profit margin by taking your operating profit or your operating income and dividing it by your revenue. The most common measure of profit is the net profit margin. This takes the profit after all taxes are considered. Again, a higher net profit is better, but it depends very greatly on the industry that you're in. Some industries, such as grocery stores, have a very, very low profit margin, between 1% and 2%. Some service businesses can have a profit margin closer to 50 or 60%. You calculate your net profit ratio by taking your net income and dividing it by your revenue. Remember that net income is your sales minus your cost of goods sold minus your operating expenses minus any non-operating expenses. Here's the cool thing about those last three profitability ratios we talked about. If you've already completed a common size income statement, and most people have at this point, you already have calculated these amounts. So your gross profit margin shows on your common size income statement, that's the 25% here. Your net operating income margin, or your operating profit margin, that also shows. Here it is 14.2%. And your bottom line, your net income margin or your net profit margin, shows as well. Here it is 7.6%. Operating return on assets is a measurement of how well our assets are producing profits. We looked before at how well our assets were creating sales, and now we're looking at a relationship between assets and profit. What we want to see here is that our rates of return on our assets is higher than the rates that we could get from other conservative investments, or at least our rates of debts that we are paying. To calculate the operating return on assets, we take operating income and divide it by assets. Return on equity. For this profitability ratio, we want to take a look at the owners and what they are getting for their equity investment. We want to make sure that the equity ownership is earning at least what they could be earning on the stock market, which very good is around 15 to 20%. And even better, something we strive for, is 30%. So if we can get a return on equity of 30%, we're very happy with our return. We calculate our return on equity by taking our net income, which is our return, and we divide it by equity. We've evaluated now our liquidity ratios, capital structure ratios, asset management efficiency ratios, and our profitability ratios. The market value ratios will be dealt with in a future chapter.